Adversity brings triumph, and this is a perfect time to make that saying ring true. For the procrastinators, forget about watching the next 18 minutes. You just sit back and relax and do nothing. You're professionals at that, keep doing it. But if you're a person that's interested in your future and what it holds, this next 18 minutes will be great watching. So sit back and relax with your partner and enjoy. Talk soon. Take care.
Right now, there's a very small number of investment-grade properties that can deliver you in excess of 6.5% investment yield, with waiting tenants in capital growth areas and with borrowing costs of just 2.8%. So you can do the maths on what this could mean to your financial health. So why are we telling you in this presentation about the wisdom of Warren Buffett? Because we believe that opportunities like this are very much aligned with the investment strategies that have made Warren Buffett so successful. If you don't know a lot about Warren Buffett, he's considered to be the world's most successful investor. His net worth is more than $79 billion US, and he's the fourth richest person in the world. His investment firm, Berkshire Hathaway, has delivered investment returns of more than 20% per year. So you could buy a share in Berkshire Hathaway for $275 in 1980. Today, that one single share is now worth more than $340,000. So as the world's most successful investor, Warren Buffett has two rules for investing. Rule number one is never lose money, and rule number two is don't forget rule number one. So we agree. And if you get an investment yield of more than 6% with an income guaranteed for 10 years and it costs you less than 3%, it's very difficult to lose money. Wouldn't you agree? The investment philosophy Buffett employs to build his wealth is really interesting. He's a patient investor. He's very strategic, and he likes to place himself ahead of the curve. So when the market starts to rise, he's already in a position to enjoy the benefits. So what mindset does he have to achieve this? It's simple. Buffett says you should be fearful when others are greedy and greedy when others are fearful. In other words, you buy at the bottom and you invest before the big upswing and have your investments in place before the majority of investors enter the market, thus pushing the prices up. That's staying ahead of the curve. It's an investment philosophy that's succeeded for centuries. You may have heard of a Rothschild bank. Well, Baron Rothschild said the best time to buy is when there's blood in the street, even if it's your own blood. Now, it might sound gruesome, but it was effective. Baron Rothschild made a large chunk of his profits during the Battle of Waterloo in 1815, when the fate of Europe hung in the balance. Investing in uncertain times led to substantial gains, but the philosophy has meant that the Rothschild family have been able to retain and grow their wealth for more than 2 centuries. When times are difficult and there's a prospect of uncertainty ahead, people often seek the advice of Warren Buffett. On the topic of when is a good time to invest, Buffett makes this observation. In the 20th century, the United States endured 2 world wars, the Depression, a dozen or more recessions and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. And yet the Dow Jones rose from 66 to 11,497 points. What he's saying here is that if you make sure you don't lose money and you buy before the market is going up, then the right assets are going to generate substantial wealth for you. Based on Buffett's numbers, if you had invested $1,000 in the Dow Jones Industrial Index in 1900, 100 years later, your $1,000 investment would have multiplied to $174,196. So I'm sure you'll agree there's a fantastic result from investing $1,000 in quality assets. But what if you'd invested in a different asset? Instead of investing in the Dow Jones, what if you'd have bought a house in Sydney instead? In 1900, the average house price in Sydney cost $930. If you had invested $1,000 in a house in Sydney in 1900, 100 years later, your $1,000 investment could be worth $362,000. That's twice as good as the Dow Jones average over the same period of time. Of course, we all know what happened to the Sydney house price market between the year 2000 and 2020. The average house price in Sydney went from $337,000 to over $1.1 million, which means the $1,000 investment you made in the year 1900 would today be worth $1,228,000. You could imagine what it would be like if you went back in time with $5,000 and bought 5 houses in Sydney. That $5,000 investment would have made you a multi-millionaire today. But possibly you're thinking it's not a good time to invest. COVID-19 could break out again. Prices could drop. Maybe it's a better idea to sit and wait things out. Or maybe you could think like Warren Buffett and position yourself ahead of the curve. Remember, Warren Buffett says to be fearful when others are greedy and greedy while others are fearful. And there's certainly a lot of fearful people around right now. So let's build a bit of a strategy around this thought, and we'll start with some content right where we're sitting today. COVID-19. There's no doubt it's been a difficult and unsettling time for all of us. But as difficult as things have been, they haven't been anywhere near as bad as we first feared. This is a headline from newspapers on the 17th of March 2020 announcing that up to 150,000 Australians could die from the coronavirus. The report said that it was possible that up to 15 million Australians could be infected with the virus. Well, it hasn't turned out that way. At the time of writing this, fewer than 7,000 Australians have been tested positive for the virus, and there's been less than 100 deaths. It just goes to show that what most people worry about actually never happens. In fact, even globally, if you look at pandemics throughout history, COVID-19 sits at the very low end of the scale. The blue arrow here in the bottom left-hand corner shows where COVID-19 ranks among pandemics. And while the financial panic caused by COVID-19 has smashed global share markets and superannuation funds and pushed interest rates into negative territory, what has been the impact on property values? Well, COVID-19 was declared a pandemic by the World Health Organization on the 11th of March. Real estate auctions and open homes were prohibited from the 21st of March. Now, if you can't conduct auctions or you can't show buyers inside a home, it makes it very difficult to sell a house. You would think that these restrictions, a global pandemic and negative news flying around everywhere, that property prices would fall, wouldn't you? Well, if you look at Sydney, from when the pandemic was declared through to the 30th of April, property prices actually went up. In Brisbane, property prices went up, and in Melbourne, property prices remained fairly static. It's interesting, isn't it? And it makes you wonder what happens to house prices during times of negativity and crisis, doesn't it? It's certainly got me thinking. So let's go back to Warren Buffett's quote for a moment about the Dow Jones in the 20th century. With the exception of a president resigning in disgrace, here in Australia we've experienced each and every one of those events that Buffett lists. So what effect do catastrophes have on house prices? To find out, I looked at the 4 greatest calamities Australia experienced in the 20th century. I looked at World War I, the Spanish flu epidemic, the Great Depression, and World War II. I think it's fair to say that each one of these events represented a greater threat than the global crisis that COVID-19 has. So let's start with World War I. World War I went from 1914 to 1918. From a tiny population of just 4 million people, more than 400,000 Australian men enlisted to fight. The loss to our nation was shattering. More than 218,000 of these soldiers were killed, wounded, gassed, or taken prisoner. And that doesn't count for the poor individuals that came back with post-traumatic stress from years in trench warfare. Our losses were the equivalent today of 1,389,500 Australian men being killed or wounded. The scale is almost impossible to comprehend. So what effect did the carnage of World War I have on property prices in Australia? Well, house prices went up. In 1914, the median house price in Sydney was $1,500. In 1918, the median price was $1,750. In other words, during World War I, house prices in Sydney increased 16%. Now let's look at an event that's closer to home, given what we've gone through with COVID-19. I'm talking about the Spanish flu epidemic. Between 1919 and 2020, the Spanish flu killed more than 50 million people globally. Similarly, today, some of the worst hit countries include Italy, United Kingdom, and the United States, particularly New York. While Australia was considered a global success story in containing the pandemic, 15,000 Australians still lost their lives to the Spanish flu. On a per capita basis, the Spanish flu pandemic was 675 times more deadly to Australians than the COVID-19. So what effect did that pandemic have on property prices? Well, once again, house prices went up. In December 1980, 1 month before the first reported case of the Spanish flu in Australia, the median house price in Sydney was $1,750. By the end of 1920, the median house price was $2,100. In other words, during the Spanish flu, house prices in Sydney went up by 20%. Now let's turn to the Great Depression. Most people associate the Great Depression with the crash of Wall Street in October 1929. It's true that October 1929 created the first shock to the financial system and investor confidence. But the bigger problem was the failure of thousands of American banks in the early 1930s. The American financial system actually shut down, and the American system was only days away from bankruptcy. It's important to have some content. Even before the crash of Wall Street in 1929, Australia was in a fragile shape economically. Today, we're used to employment rate being around 5%. Before the Wall Street crash in 1929, unemployment was already at 11%, more than double what we have today. The Great Depression hit Australia much harder than most other countries for various reasons. By 1933, our unemployment rate was more than 32%. Between 1930 and 1934, we had the second highest unemployment rate in the world. Only Germany, who was battling hyperinflation and the effects of losing World War I, had a worse unemployment situation than Australia. We didn't really start to recover until 1938, when our major trading partners started rearmament programs in the prelude to World War II. Even by 1939, our unemployment rate was still more than 11%. So what effect did the Great Depression have on property prices in Australia? After an early correction in 1929, the median house price in Sydney in 1930 was $1,900. In 1938, when the recovery started, the median house price was $1,900. By the way, if 32% unemployment wasn't bad enough, the initial government response was the opposite of what it is today. They actually cut back on spending. They actually increased interest rates. So Lord only knows what that meant, that the interest rates jumped from 3.5% to nearly 12%. So despite all that, during the Great Depression, after the initial correction, there was no net movement in Sydney house prices. Finally, we look at World War II. Between 1939 and 1945, more than 75 million people were killed in the war. Australia's very existence was under threat. Japan bombed Darwin, and we faced the very real prospect of being invaded by a hostile military force. So what happened to property prices? Well, property prices went up. By the end of 1939, 3 months after the war was declared, the median house price in Sydney was $1,990. 6 long years later, at the end of 1949, the median house price was $2,400. In other words, during World War II, Sydney house prices went up by 21%. Then when the wartime finished, when controls were removed, house prices more than doubled in a single year. So what can we learn from all this? Well, first of all, in times that were far worse than what we're going through right now, house prices went up in value. It's the best opportunity you will have to position yourself ahead of the curve in terms of future gains. So think about it. Would anyone have believed in 1914, when war broke out, that house prices would go up? Do you think there were masses of people flooding into the property market? What about when the Spanish flu pandemic hit, or when World War II started? You would have thought they were good times to invest in Sydney? Yet those that did made money. They didn't fear the uncertainty, and they didn't let those things hold them back. And now what we're facing is nowhere near as bad as a world war or a Great Depression. Warren Buffett says, be fearful when others are greedy, and greedy when others are fearful. There's no shortage of fearful people at the moment. This is your chance to get ahead of the curve. And you have one advantage in your favor that has never been available to others in history, in the investing history of Australia. We're in a period of record low interest rates. Official Reserve Bank interest rate is 0.25%. The 5-year bond rate is 0.39%, and the 10-year rate is 0.91%. In other words, interest rates aren't going to be increasing anytime soon. There's never been a better opportunity to get investment yields of more than 6%, with tenancy demand in growth areas and borrowing costs below 3%. In the history of Australia, this has never been possible before, but the value is way more than just in positive cash flow. At Compass Property Investing, we analyse investment opportunities in alignment with highly successful strategies used by Warren Buffett. We have a unique financial modelling strategy that considers your financial health and future wealth on pure cash flow basis. We'll show you how much better off you can be even before your investment goes up in value. You'll see in precise terms just how valuable positioning yourself ahead of the curve can be. So how do we do this? Well, we do it by smashing your home loan for a start and paying off your home loan years faster than you're on track to do right now. We do it by getting tax credits and reducing the amount of tax you pay, and we do it by using cash flow positive properties that give you immediate passive investment income. All of this is done with no need to change your current lifestyle and no change in your current spending. This unique financial modelling will be done for you by both our in-house team and our circle of financial professionals whose business days are spent working on data and analysis. When you have the right information in front of you, investment patterns emerge that can help you make a lot of money. So how much better off could you be? Well, right now there's no better asset class to invest in than high-quality residential property. Let's do the financial modelling for you and allow the numbers to speak for themselves. If COVID-19 has taught us anything, it's to be proactive about our physical health. If we have symptoms of flu, we go straight to our doctor because an early attention can help people from suffering from serious health risks in the future. Doing something right now can help protect us and our family from illness and hospitalization. Well, your financial health is no different. Your financial health is just as important as physical health for a happy, comfortable life. If you notice early symptoms that aren't quite right, you need to have them checked out. Are you being proactive about your financial health? Some people leave things too late and their financial position can't be restored to full health. Even to earn even $60,000 a year in retirement, before you stop work, you'll need to invest in assets, excluding the family home, of $1,714,520. So are you on track? Here's what you need to do to find out the status of your financial health. You can learn how to improve your financial health with an initial consultation for less than 1 hour.
Well done. Great work in watching that. I'm sure you got a lot out of it, but to get even more out of it, you need to be in touch either with myself or my team, and for no cost, no obligation, we can talk you through a personalised situation about yourself, okay? How you can benefit from these uncertain times. Just do something, be in touch. Talk soon, take care. Bye for now.